So VOO and VTI are two of the most popular index funds out there, but is one of them better for your portfolio? What's up, you guys? Welcome back to my channel. This is Alice. Welcome back to Money with Alice, where we talk about personal finance, investing, and so much more. If you haven't already, please hit that like and hit that subscribe so you don't miss out on future videos, and also don't forget to turn on the notification bell so you can be first to be notified when I have a new video. So, I've been seeing a lot of beginner investors ask this question. Do I want to buy VOO or do I want to buy VTI? Now, before you ask, what are VOO and what are VTI, make sure to click here to see my video where I explain all about index funds and how to get started with investing with as little as $500. Now, just a brief summary of index funds for those of you who aren't familiar. Index funds are a basket of tickers or a basket of companies that are publicly traded that have been created to give investors the benefit of diversification. So using an index fund is sort of like buying a fruit basket. In that case though, rather than it being fruits, this is a basket of different stocks. So VTI and VOO, the reason they all start with the letter V is because they're offered by the same company. They're both offered by Vanguard. Now these two happen to be two of the most popular index funds that Vanguard offers. For beginner investor, you always want to buy something that's mostly diversified, but in this case, VTI and VOO seem like the most obvious choices, but which one to pick between the two seems to be a little more confusing. So let's discuss about the VOO real quick. So what is the VOO? Now, the VOO is Vanguard's S&P 500 index fund. It tracks the S&P 500, which contains the 500 largest companies that are publicly traded in the US. These companies are based on the market size, also known as a market capitalization. They'll rotate in and rotate out of the S&P 500 as their sizes change. So for example, earlier this year, Tesla being included in the S&P 500 when it became really large was a super big deal, because then every single person who owned the index fund or was managing the index fund, for example like Vanguard, had to rotate out and rotate in different companies in order to make sure their balance actually reflected the S&P 500. Now the VTI is Vanguard's index fund that tracks the total US market. It tracks every single publicly traded company in the US. There's about 3,500 different companies within VTI. They track the largest, the medium, all the way down to the smallest companies because they track every single publicly traded company in the United States. Now, in terms of the overlap here for VTI, the Vanguard Total Index Fund, about 82% of the holdings is based for the largest companies, meaning that about 82% of the holdings within the VTI overlap with VOO, which is the S&P 500 index fund from Vanguard. So if 82% of VTI is within large caps, what are the remainder? Well, that's a great question. So 82% is for large caps, 12% is for medium, so medium-sized companies, and the remaining 6% is for small caps, so the smallest companies. So again, 6% small caps, 12% mid caps, and 82% large caps. And that makes up the VTI Total Market Index. Let's talk about expenses real quick. Whenever we have an index fund, we care about fees, right? We want to pay as little fees as possible for as much performance as possible. Well, lucky for you, VTI and VOO both are very low in fees, and they actually have the same exact management fee breakdown, which is 0.03%. This means that if you invest $100 into VOO or into VTI, every single year you can expect to pay 3 cents for every $100 invested. So really the expenses here are completely identical between VTI and VOO. Now let's compare the difference in dividend yield between the VOO and the VTI, a great way to generate some passive income for your retirement. Now the difference between VOO, the S&P 500, and the VTI, which is the total market, in terms of dividend yield, they're actually pretty similar. VTI is a little bit higher at 2.07% dividend yield, whereas the VOO has a 1.97% dividend yield. If you're confused on the meaning of dividend yield and what that infers for your portfolio, check out this video that I made all about dividends to help you get started. Let's talk about performance. Both the VTI and VOO here have pretty similar performance indexes. The last 30-40 years, if you take a look at the average, they've both returned about 10% annually. Now, the VTI slightly overperforms compared to the VOO, 10.65% versus 10.55%, which actually makes a lot of sense because the market theory that is in play here is something called the risk-reward premium. So with the VTI, since they have exposure to smaller companies, these are deemed as higher risk. And usually what you expect to see is that higher risk, you should be compensated for a higher return. So because the VTI has exposure to more smaller companies, more risky companies, that's why it's a 10.65%, whereas the S&P 500, the VOO, only has the 500 largest companies, safer investment, but a little bit of a lower return, 10.55. Again, the difference is pretty small at 0.1%. Now, after discussing all of this, which one should you buy? Well, both of them are actually pretty similar. Let's take a look. They're both very diversified. VTI has over 3,500 companies. VOO has 500 companies. Both of them have pretty low fees. They're both at 0.03% annual management fees. And also, their performance is pretty similar. Over the last 30-40 years, both of them have returned about 10% annually. So, which one is right for you? Well, personally, I really like having the VOO because it provides exposure to the 500 largest companies in the US. Performance is pretty good at 10%, and also the larger the company, the safer it is. But you can also opt for the VTI, which has a even bigger area of diversification with 3,500 companies. And given that there is a little bit more of mid-cap and small-cap in the company mixes, you get a little bit of a higher percentage in terms of performance. Another way, though, to mimic the VTI exposure is to buy the VOO, so buy the S&P 500 index fund, but then in addition to buying the S&P 500 index fund, also purchase some small-cap index funds as well. That way you get the large cap exposure from your VOO, but also small cap exposure from a different index fund, which sort of mimics what the VTI or Vanguard Total Index would provide. Ultimately, though, it's your own portfolio. Make sure that the strategy fits in with the rest of your portfolio construction, and make sure to always do your own diligence before you commit to buying anything. Thank you so much for watching. I hope you guys enjoyed this video. If you did, please give this video a thumbs up. And I would really appreciate if you can maybe share this with a friend and also subscribe so you don't miss out on future content. If you have any other topics about investing, personal finance, or generally making your overall financial health look a little better, check out the rest of my content on my channel. I have a lot of videos and good resources that could be helpful for you. Thanks again for watching, and I'll talk to you guys real soon. Have a good rest of the evening, morning, noon, whenever and wherever you are. Bye. Oh, living in New York.